Joining us for analysis of the equity scene is Devin Schutte from the Rebay Group. Thank you so much for your time, Devin. Now, markets are mostly in the red today again, as the U.S. markets also have come back from the holiday yesterday. So quite a lot of things, interesting things are happening. There are developments happening with Trump, where now we have possibility that he could make a comeback, but also we have still elevated geopolitical tensions, particularly in the Middle East. Just talk to me about some of the drivers of market sentiment that you have been paying close attention to.
Yes, thanks, Nancy. So, I think the only constant that we're going to know for markets going forward this year is that there's going to be a lot of unknowns and resultant volatility. And whether that comes from guessing what central banks are going to be doing with monetary policy, or what politicians are going to be doing, or the outcome of the biggest elections ever held across many countries this year, it's definitely going to make market forecasters' jobs difficult. And today we saw very much a risk-off mode across the board. And that was as market participants are really grappling with what does the trajectory of inflation and interest rates look like this year. I think the market is still pricing in fairly high chance of the Fed cutting in March, and the ECB, who also says their next move is down, is probably going to be in April. But as we know, trying to get from last year, and almost everyone getting it wrong, that's likely to change very quickly. And I think we're seeing that dynamic with markets as well, trying to get a handle on where rates are going, which is really the big game in town at the moment.
Yeah, and of course, one of the big focus areas tomorrow will be the China GDP figure that is coming out for quarter four. Of course, quite interesting, as we have still seen the property sector there struggling, but also with the lack of a bazooka-style stimulus there on that front. Of course, as we're talking about, the markets and volatility, let's go into 91. It came out with its update on its assets under management for the period ended December. So they're saying that the assets under management were just over 124 billion pounds in December 2023. That was lower than the AUM of 132 billion pounds in December 2022, and basically a flat quarter on a quarter. Is there anything that you can maybe tell us about, just the position that asset managers are under right now with what we are currently seeing in the markets?
Yes, so asset managers' main revenue driver is the amount of assets that they manage. And generally, financial markets had a good year last year. We had the S&P up kind of mid 20%, the NASDAQ up a lot more than that. Fixed income assets are starting to generate yield. So there was a natural increase or almost an inflation that should have raised just existing assets. So, for an asset manager to have flat or slightly negative assets meant that there were definitely outflows there. I think there could be a few reasons for that. Overall, the asset management industry is highly competitive. Investors are spoiled for choice, and 91 being a large global asset manager, a true global asset manager, is competing with some very big other money managers. So yeah, I think asset managers overall would have had a decent year. Some would have got performance fees on the back of outperformance. But yeah, that asset under management number is a key metric to watch.
All right. Well, as you're talking about highly competitive sectors, there's another one, and that is food retail, the grocers. What was interesting is that Pick n Pay posted an announcement that Alan Gray has increased its shares in the company, its stake in the company to 10.11%. We did see that stock rising about 4%. And I'm actually wondering if this is maybe the start of a vote of confidence for the company, or is it maybe just way too cheap to pass up?
Yeah, look, I'm definitely seeing a renewed interest in Pick n Pay as a potential turnaround story. I think the reality is just the gap in execution between Shoprite and all the other food retailers is just massive. And I think what you're seeing investors betting on now is that one or two of the challengers might actually succeed in closing that gap in market share. Make no mistake, it's a really, really difficult act to follow. Shoprite has just executed incredibly well on almost every fund. You can't fault them. You know, they've actually been expanding margin in this very competitive space. But my sense is that Pick n Pay's got a fighting chance. You've got Sean Summers at the head there, and you know he's going to go to the shop floor and really try add value to customers, and you know it'll be interesting to see if that does win them back market share.
Yeah, and they're indeed making some moves there, particularly Sean Summers, as we did see last week that there has been a rejig there in the leadership team. Now, let's get to your stock pick for today, Devin. What will it be?
Yeah, it's one we've chatted about before, Zanati. It's TLT. It's the iShares 20-year US Treasury Bond ETF listed in the US. And here you're getting long duration exposure to US Treasuries. Now, why I like it, there are two reasons. One, if we do get a soft landing coming this year and we ultimately do get interest rates coming down, it's likely to benefit. Or if we actually get a more harder landing, US goes into recession, that fixed income exposure will be a nice hedge in portfolios.
All right. Well, thank you so much for your time and for your insights on what has been driving the markets in today's trading session. That was Devin Schutte from the Robey Group.